Walmart recently reported an 18.8% increase in net income, alongside a steady profit margin of 3.1%. Yet surprisingly, their free cash flow for the quarter was negative, sitting at minus $1.95 billion. This paradoxical situation has puzzled many investors, who often assume that rising net income and stable margins should translate into positive cash flow. This financial anomaly at Walmart arises at a time of significant interest in the company. Set against a backdrop of ongoing earnings reports and industry movements, Walmart's next quarterly earnings are scheduled for August 20th, 2026. The retailer's revenue for the most recent quarter ending, April 30th, was a staggering $177.75 billion, marking an impressive 7.3% increase from the previous year. Such revenue growth showcases Walmart's continued stronghold in the consumer defensive sector. However, despite these strong figures, the negative free cash flow has become a focal point of discussion and debate. The timing is crucial, as investors are closely monitoring retail giants during a volatile earnings season. Breaking down the financials further, Walmart declared a quarterly gross profit of $44.69 billion, with operating income reported at $7.49 billion. Their net income, a healthy $5.33 billion, reflects the 18.8% increase from the same quarter a year prior. It indicates profitable operations and efficient cost management, suggesting that core business activities remain robust. Additionally, Walmart's capital expenditures surged by 34.1% to $6.68 billion, a likely contributor to the negative cash flow. This substantial investment into capital projects could indicate an expansion strategy or modernization efforts. Such investments are often viewed as necessary for future growth, but can pressure immediate cash reserves. Interestingly, they also spent $2.08 billion on share repurchases during this period, showing a commitment to returning value to shareholders even amidst rigorous capital investments. The crux of the debate revolves around whether these cash flow figures indicate underlying issues at Walmart or are merely a strategic investment decision. One side argues that the increased capital expenditure denotes purposeful investment in growth and infrastructure, perhaps linked to their recent acquisition of Vibe.co, as reported by Piments.com. This acquisition is part of Walmart Connect's vision to enhance their advertising capabilities. Such strategic moves are typically aimed at bolstering long-term revenue streams. On the other hand, skeptics suggest potential trouble in cash management, given the company's high trailing price-to-earnings ratio of 39.5, which may imply the shares are priced for significant growth expectations. Additionally, with a share price lingering over 16% below its 52-week high, some might read this as market doubt. This split in perspectives highlights the uncertainty investors feel when future strategies and present cash flows appear misaligned. For investors, this situation underscores a critical lesson often overlooked. A declining stock price does not inherently signify deteriorating business fundamentals. Just as Walmart's cash flow seems misaligned with its net income growth, investors must look beyond surface figures. Recognizing the impact of strategic capital allocation or external market conditions is vital. Large capital investments and acquisitions can be part of a longer-term strategic trajectory that might not immediately reflect in cash flow positivity, but set the stage for future growth. Understanding the broader context and strategic goals of a company can reveal much about its future trajectory beyond mere numbers. It is exactly what Whisper was built to show you. Whisper.live